Hello, everyone, and welcome back to the Make Life Less Taxing podcast, the show where we uncover what really creates freedom in life and business, and we'll explore stories of those who've learned how to build wealth with purpose.
Welcome back to the Make Life Less Taxing podcast. I'm your host, Daniel Hanzelka. This is the show where we explore how people, families, and business owners can stop losing ground to systems that they don't fully understand and start creating lives with more clarity, control, and freedom. Today's episode is the beginning of a new ongoing segment that we're calling the Tax Intelligence Files. These conversations are designed to help you see the tax system differently, not as something to fear, but as something to understand and ultimately to use intelligently. I'm joined today by Miguel A, a founder of Palma Financial Services. Miguel is a tax strategist, a CPA who specializes in wealth creation and strategic planning for business owners and high net worth individuals. Miguel and I have done podcasts before, and I wanted to bring him back, this time as a regular voice because of the conversations we have about tax strategy, structure, and financial intelligence are simply too important to have. Once we had the conversation, I knew I had to bring him on. We also brought him on as a faculty member of the Institute of Untaxable Wealth, where he helps educate financial and insurance professionals on how to make life less taxing and how to keep what is theirs and how to break free from the traditional financial systems that are quietly eroding so much of people's wealth. Miguel, welcome back to the show.
Thank you very much. It's nice to be back.
Great to have you on here. Miguel, let's start with, why do so many business owners experience the IRS kind of as an enemy, where the tax code was really written for them?
You know, I would say, number one, it has to do, the way you look at it is the way we've been trained, right? The IRS is the enemy. They're the boogeyman that is out there to get you. I would actually say this: the tax code is a love letter, 4,000 pages worth of tax code or a love letter.
Hold on. I love that. A love letter? Wow.
Yeah.
I like that language. I like where you're going with this.
Okay. Let me go back. So a lot of times people look at the IRS because that is the framing, right? You go into your CPA and you come up with something and the CPA says, the IRS is going to come and get you and put you in prison. It could happen. And I actually, we're doing some videos on that, and I'll share that with you later. There's some aggressive schemes out there. I had a client and a very dear friend come to me and say, hey, I got a deal. Somebody's telling me that if I put in $100,000, I get to deduct $500,000. So I'll leave you in suspense. I'll loop back on this. But your original question, why is it that the taxpayer sees the IRS as an enemy? I really believe the tax code is 4,000 pages worth of love codes, love letters to business owners. And think about that for just a minute, because that's the way I believe we need to see it. It's a love letter. We just never read it. We got to read it. We got to understand it, right? And our job is to get away from fearing the IRS, right? All I want to do is get ready. They select you for an audit. Every single strategy has to be based on the code. We don't make stuff up. Like a 1 to 5 deduction, that's a no-no, right? That would be a listed transaction. But if we do things right, then we look at the tax code, we read the love letter, right? And we understand it together. Then from there, we document it, and then we implement, and we're going to be okay. We're going to be okay. It happens. You get audited. To me, it doesn't have to be a crisis. Look, you have a question? Here's my research. Here's what I use to base the deduction on.
I think the way that I looked at it when I was working with accountants a few years back when I was an advisor, it's up to the interpretation, right? But you can't get way too creative. And I think this is what you were mentioning before. Some people get way too creative to it and they're trying to push something through. They know that is not going to go through. They're just trying to kind of test the waters and figure out if it's going to work. But I think it comes down to the interpretation. And I think often if you are prepared, just like going to court, right? Like when you go there and you're prepared and you have your facts and you have everything, they will actually consider it and they will actually look at it. I think most people, they're just looking for that shortcut, right? They're looking for a way how to kind of get away with something. And I think this is where the whole idea comes in that, as you mentioned, that, IRS is the boogeyman. They're going to get you, and I do definitely love the framing that you've had. It's a love letter because, again, it just kind of shifts the whole perspective. So where do you see that most business owners unknowingly use the tax code kind of backwards? And what usually causes that?
Here again, getting back to the mind frame, and I want to make a couple points on that.
Yeah.
Every deduction exists because it rewards a certain behavior
Mm.
that the government wants to promote, right? Getting back to our kids, right? We have rules, and those rules must be followed because we encourage you to read every night because you're going to develop certain skills that you're going to have. The same thing with this. Congress put in place some rules, the oil and gas credit, right? We want to have energy independence. So we want to encourage the taxpayers to put money in there. And now you're getting a huge deduction and you're getting royalties every year. So again, Congress is encouraging some behavior with the code. Three more points on this is that think of the IRS as the referee, right?
Hmm.
So if I'm playing football, the referee is not my adversary. They're there to enforce the rules. We follow the rules and they're going to make the call in our favor, generally, right? We're
Mm.
human beings. There's still mistakes that are being made. The other thing is, I was looking at this and think about it for a minute. 85% of taxes are paid voluntarily. The IRS doesn't need to go out, hunt for people, right? Americans are good. We follow the rules. 85% of taxes pay are voluntary. So they don't have to be going out. It's the 15 maybe percent that maybe they're not following the rules and the referee is gotta pull out the red card or call offline or whatever, right?
Yeah.
Or call a ball or a balk or whatever if you're into baseball. So that to me is very important. And the last thing I want to leave you is that if you're building something, you get rewarded with the tax code.
Mm. Do you know
So
what?
what
I
was
like your frameworks on this. And listen, money is really, it's an inside game, right? You mentioned mindset and you mentioned all this. I love the framing that you have. It's a love letter. A referee, again, I think it works the same way because IRS didn't write the code, right? I believe it's the Congress that writes it, right? So
exactly
again, they're there just to enforce it, but it was really written in the mind from the people that are going to have to go and use it. So, businesses that got preferential treatment, certain ways. And the last point that you had, like, hey, when you actually go and build something, you're actually contributing to society. You're contributing to, the benefit not only of the people, but to the government, to the whole country. Therefore, when you're contributing and you're actually building something, yeah, you should have some type of breaks. That's why I think most business owners, right, have, I don't want to call it better preferential treatment with the IRS, but because they're building more things. When you're an employee, you're contributing, but again, you're not necessarily building. So I think I like the way that you have kind of framed that, and it's definitely 100%. It's an inside job, right? Like it's the way that you think about it, and I think most people have been taught wrong. As in, I call myself a recovering CFP. Why? Because I realized that they really didn't teach me how to help people. They were teaching me more or less how to sell more of their products, right? And when I kind of found out, when I unplugged from the matrix, I started to realize that, yeah, you know what, there is a little bit more beyond that.
Yeah, I mean, it's like you asked the typical advisor, and I know I'm deviating a little bit, but it's related. People don't talk about sequence of returns,
Yeah.
right? That is very, very important when you're talking about investments and planning. The other thing is that we focus so much on accumulation, right?
Mm.
I don't do financial advising, but I look at the consequences, right? So we focus so much on building assets, but we never talk about distribution.
Mm.
And
That's
as
the
my
more
client,
important part. It's kind of like climbing the mountain, right? Most people climbing Mount Everest die on the way down, not on the way up. Right?
exactly,
It's an
and
important
and
point.
people are shocked to hear that, but
Yeah.
that is the reality. So going back to your question, where the business owners use the tax system backwards, I gotta go back to two clients. This guy has got a very, very successful business, probably nets about $2 million a year.
Mm.
And I was shocked when he said, Miguel, every single year I was encouraged to buy a car. And I said, "You were?" "Yeah, I was in," and now that you explain the real estate and how I can buy warehouses for my business and buildings, I got it, right? Or
Mm.
I could buy rentals. I definitely got it. And my wife is a dentist, but maybe can stop doing that now that we have a child, and she can help me with the real estate. And I just felt so bad for him,
Mm.
right? Because he was doing what they were telling him to do. And then you have some other clients that generate a significant loss, but because they're pulling the money out of the S corp all the time, because they don't have enough basis, they can't take the loss,
Mm.
right? And that's another big shocker to business owners. So to me, tax preparation tells you what you owe, right?
Mm.
Tax planning tells you what you could have kept, right? Most times when people come to us, we can still do something. We'll probably have 1, 2 strategies that we can still implement, but there were 5 strategies before that we could have implemented if they had come earlier, right? So that's the main thing. So a lot of times I tell people you can do in January uh,
That's too
what you
late.
could have done, the year
Yeah.
before, right? So a lot of it has to be where, again, I don't want to discourage people. We have 1 or 2 strategies that are very powerful for business owners that we can still implement, but we have a plethora of them
Yeah.
prior to year end.
Well,
So a lot
yeah,
of
you bring
times
a great
people
point.
call.
One of them is, like you said, and I've heard that before. Uh, so I want to go back to, you just shared a story of somebody was encouraged to go buy cars. Again, nothing wrong with the strategy. But what I feel when I hear that, going like, hold on, but you don't just have to buy cars. There are other things that you can go and do. And I think this is where, not that they were giving the wrong advice, they were giving the right advice, but the advice was a lot more broader that they should have been given, that they could have bought more than just cars in order to get that deduction. Because the reason they were told to buy the car is to get the deduction, right? Would that be the right assumption?
Absolutely. And then the other thing is you look at it and how can you buy a car? This person buys expensive cars. How can you buy a car for $200,000? I didn't know you could buy cars that expensive,
Yeah.
$300,000 every year and write it off 100%, right?
Yeah.
So that's one thing that the referee may look at it and call you out of bounds if
Yeah.
that's the case, right? Because
Yeah.
it doesn't make sense. The other thing that I see a lot of times, people are setting themselves up for failure because they got a car and they use it 100% for
Is
business,
it?
right? If they had 2 cars, then that could
Yeah.
fly, right? If you only have 1 car 100% for business, it doesn't work.
Yeah.
So I would say that if you call us in March, the game is already over, right?
Yeah.
But if we meet, there's a timing issue. If we meet, you can deduct the same equipment. You're
Yeah.
going to have the same business need. But if you do it at the wrong time, wrong timing, $40,000 are gone,
Yeah.
right? So a deduction. Oh, and one last thing on this is that a lot of times we push deductions, Daniel, but we forget that a deduction is not as valuable as a credit.
Yeah.
There's so many credits out there that business owners could have access to. There's a credit that's been around for a long, long time that if you hire people within a certain group, right? People that are disabled, people that have been in the military, people that are getting assistance from the government, you get a credit and that could be significant, right? So I think that that's another thing that I don't see enough of is looking at the credits because the credit is dollar for dollar, right? A
Yeah.
deduction is just the percentage
Yeah.
based on your tax rate.
Yeah, you bring a great point. I think this is where the backwardness comes in, that they're focusing on the wrong things. Now, you mentioned a couple of things like what's the real difference between tax preparation and tax planning, and why does the gap matter so much?
I believe that tax preparation is going to give you the map. Think of an architect, think of an engineer. You're engineering the outcome,
Mm.
right? So you're engineering the outcome where a lot of times people come to us and we say, "Where are your financials?" They say, "Oh, we're still not done," and maybe we're in March, right? So if you don't know what the number is, how can you plan? Number one. Number two, you're pretty much stuck, right? We come up with the number, it's too late. Now we just filed a return
Mm.
based on the number. And a lot of it has to do with just being reactive. And I call it Groundhog Day, right? Every year you keep doing the same thing. It's like, I think it was Bill
Yeah.
Murray that kept
Yeah.
waking up and it was the same thing.
Yeah.
So
No, no.
it's all about
You
engineering. Sorry, it's all about engineering results. And something that we find that is very interesting is that some clients we come in 1 year, maybe we save them 275, 375,000, and they're okay with that, right? They feel that that's enough, and they go back to doing it the old way, right? Because now they gotten maybe two, three strategies, and they feel that they got it. And it's really interesting because they feel that that is sufficient. And I really believe that a lot of that has to do with programming, right? You cannot eliminate the taxes 100%, right? So there's something wrong in people's mind because they believe they have to pay taxes. But no, the tax code says it's okay, right? If you do the right things, you're going to get rewarded. If you implement and build the right strategies, that actually is going to work. And it's okay. As long as it's legal, you can report zero taxes.
Mm.
So it's something that we're beginning to notice because we've been doing this for so long that some people they say, I don't know, first year 150, second year maybe 250. And then they say, okay, so now I'm saving 250. I'm okay. I don't need to do anymore. But we forget that there are probably about 1,500 tax strategies with credits and all
Yeah.
those things that can be implemented. But I think that the mindset is still there where it's wrong not to pay something.
Yeah. Well, you know what? When it comes down to, in your experience, why does knowledge, and we keep on talking about that it's a mindset, not income, tends to determine how much tax someone ultimately pays?
I believe the income generates the tax bracket, right?
Mm.
But the knowledge determines where you actually pay at that bracket. So you make
Mm.
$800,000. Two people come in, they both make 800,000. One is going to be stuck with a bill of 280, and the other one is probably going to be at 50,000 and sometimes even zero. Right? It has to do with the knowledge because before the end of the year, we're looking at things and we're determining what is the relationship between the strategy that you're going to implement to yield the result that we want. So by the time April comes around, there are no surprises. It's just
Mm.
execution. So saving, I always look at the numbers, and I think our average is about 125 average, right? Some clients save a lot more, some a lot less. And it's not magic. It's just planning before it's too late. With some clients, it takes one strategy. With some other clients, it takes three strategies. But I also have very dear friends, and I think of one all the time that I've known him for 20 plus years. And he always writes a check for $1 million. And if he's watching this, I think he'll know that I'm talking about him. Right. But the problem is we know what we got to do, but he's always very busy or he doesn't
Mm.
have the help or the bandwidth to implement it. So
Yeah.
that happens. Well,
Yeah. No, no, you bring out a great point. I mean, you said before that really when it comes down to IRS, often, as you mentioned, you compared it to a referee. All they're doing is responding to somebody's choice, right? Like they chose to go and do something, right? They're not targeting them. Now, can you go a little bit deeper into that?
yeah. I mean, I'll go into something, warn people not to do it. Number one, you heard of conservation easements, right? And the idea is that you buy into something and then you donate it and then you get a deduction.
Yeah.
That deduction can be 2.5 times whatever you put in. So if you put in 100, you get 250. Some instances, it's much more than that. Is maybe 300,000 if you put in 100, 400,000. In this case, the one that I've been dealing with, Now, as my client put in 100, he gets a deduction for 500,000, right? So as soon as I saw that, I knew there was a problem because in 2024, the IRS came out and said, if you're going to do anything like this, the maximum deduction that you can get is 2.5 times.
Hmm.
Right. So if you put in 100 and you get 250,000, you're okay as long as everything is done correctly. And there are about 6, 7 steps. But as a listed transaction, number one, you have to tell the IRS. Otherwise, if they find out, you're going to pay not only the taxes, but 40% in penalties, right? Think of the referee, right? There are penalties and interest because you didn't follow the rules of the game, right? So in this case, the response that this person gave me is, my buddy, he's a surgeon. He's been doing this for 3 years. Nothing's happened to him. Well, the IRS plays the long game, right? The fact that nothing's happened to the surgeon, it doesn't mean that he's clear. It means
Yeah.
that they're going to go after the promoter. They're going to have to sit down with that person and figure out what they're doing. And then after that, they'll go after the investors. They'll look at the K1 and eventually they'll get to that person. But it's something that they're targeting, right? Because they feel that right now, with the rules not being followed, is unfair to the other team. If you think about it, right? So
Yeah.
they're making sure that this is fair for the other team or the people that are not doing this. So then after that, you don't have statute of limitations. With these type of transactions, they can come back 5, 6, 10 years, and you're still on the hook. And ultimately, what I tell people is this: remember, it doesn't really matter who the advisor is,
Hmm.
and it doesn't matter who the promoter is, and maybe the attorney, you got a legal opinion, and the CPA, right? The one that is left holding the bag is a taxpayer, you. So that's an example of when people break the rules and there are severe consequences.
Yeah. No, you bring a great point. I remember when my accountant does all of my stuff. It's like, yeah, it's doesn't matter that they're doing it. If they do it wrong, you're the one that's responsible, right? You kind of go there. It doesn't. It's kind of like one day when we're going to be standing in front of God, right? We can go, well, he made me do it. No, it's just going to be us 101, right? It's kind of the same thing. Now, listen, why do certain activities, and we kind of talked about it a little bit at the beginning, activities like business ownership or real estate are quite heavily, and I'll call it incentivized, in the tax code. Why is that? Like, how do you view it?
I always go back to looking at what is it that the code is trying to achieve. Obviously, the code wants to tax, right? They want to
Yeah.
collect taxes, but they also want to incentivize certain things that are going to help society. And it's interesting, right? Every administration has their own point of view as to what is beneficial to society. Right now, we're dealing with someone that is sells solar panels.
Mm.
So the fact that the solar panels have gone away, right? This administration doesn't believe in green, doesn't believe in um, electric cars. So that incentive has gone away, right? And you can go back and say it's wrong or whatever, but it is, that's what Congress feels, and that's what the president wants, and it was approved by Congress, and that's now in the code. So this business is suffering now because people would put in solar panels because they had the credit, right? Tesla, some would say, is suffering
Mm.
for many reasons, but one of the things is that the credit for electric vehicles have gone away. So you see, the encouragement before was the green, uh, going green as much as possible. Now, one loophole that was there, or people call it loophole, but it's actually the law, was the QBI, where every business gets a 20% deduction on their net income. So you only end up paying 80%. And generally, these are for people that bill or hire, right? So the government, both administrations, the last one and this one, they want to encourage businesses to go out there, be profitable, and hire people and do all the good things that small businesses do for the economy. So they still have this law where you don't have to pay taxes on 100%. You only pay taxes on 80%. That is the QPI deduction. So a lot of times I believe the wealthy don't pay taxes, not because they're cheating, it's because they're structured properly.
Mm. That's a great point, and I think they're smart. So no, you
Yeah.
bring out a great point. Now, if someone suddenly realizes, that they've really been thinking more like an employee instead of an owner, right? Especially for business owners, what would be kind of the first shift mentally, that they need to make?
The main thing is number one, you said it earlier. Yes, the tax code favors investments, certain investment. Real estate investment is one of them. And short-term rentals is another one, right? There's some certain limitations in order for you to get the deduction. You don't have to be passive. You got to be involved. One of the strategies that we use a lot is short-term rentals because as long as you're doing the majority of the work for your short-term rental, it becomes a business. So you don't
Mm,
have to deal with passive losses. So we have professionals, lawyers, dentists, surgeons, vets that do have the short-term rentals and they get huge deductions as a result of that. Right. So they're W-2 earners and they've seen the taxes go out before they even get their money, right? Because the
mm,
taxes are
mm.
withheld at the source. Where the business owner, there is a completely different game. So yes, the code benefits individuals that invest in real estate and start businesses. So that's the first thing that I would recommend for W-2 earners is you're getting killed. So let's figure out what we need to do in order to minimize those taxes.
I think what I'm getting from this really, and I have never really looked at it, Miguel, and I appreciate you kind of expanding my view on that, is that if you're actually contributing, right? That's what you got to look at. If you're actually contributing to society, contributing to, look at it, the government actually giving something, then the government will actually going to reward you for that, all right? When you're doing something that actually benefits, again, you kind of mentioned solar and all this. Again, it's basically benefiting to the view of the previous administration, how they were looking at that certain thing. So again, it was contributing to something, right? And then you can get kind of incentives for going and do that because again, it kind of helps the whole. And I really appreciate kind of what we've done in this episode, kind of looking at it that, the IRS, and I love, again, a love letter, the language you were using, referee, right? They're there actually to help you with and give you rewards if you're actually contributing is a great way to really help people to understand that they need to shift the way that they look at the way that they're paying taxes. And a few years back when I was an advisor, I used this story that we basically have, there's kind of like these four different assets. We've got core assets, we have experiential assets, we have contributory assets, and then we have financial assets. And under contributory assets, I always told my clients that taxes, right, are a contributory asset. And they're like, oh, no, hold on. It's a liability. How can you call it an asset? I said, well, it's an asset because you get to choose how much tax you actually pay the way that you structure your finances. And I think, unfortunately, most people kind of like don't do any planning. They don't do any thinking ahead. They get to the end of the year, they don't do anything. And then they go to their CPA or an accountant and go like, fix this. And most of them, unfortunately, what they do, all they do is they do the compliance because they can't do a lot of planning ahead of time, right? And they just kind of go and do the, cross the T's and dot the I's and go, hey, you've made X amount, you've got to pay X amount. Instead of going like, hold on, don't go through the groundhog day like you mentioned and going like, hey, why don't we start planning right now for next year? What are the things that you can do? What are some of the strategies that you can actually go and implement? And I know that you can always do something after the year kind of starts over again, but it's a heck of a lot easier when you do it in the calendar year because you can take advantage of a lot more strategies that the government and the incentives that the IRS and the government basically gives you through the IRS code.
Absolutely. And getting back to analogies, yes, I believe the tax code is a love letter. We just got to read it. We got to know how to read it. And also, you can look at the tax code as a tool, right? And that
Mm.
tool can
Yeah.
either work for you or against you, depending on whether you know how to use it or not. And something simple that I always tell my clients, you have to start a business. Yes, I'm busy. Well, you got to start a business. And now with AI, think of how many things we could possibly do or set up a business with our families where we could generate some of those deductions.
Yeah.
And something to incentivize individuals, I always tell them, Daniel, look, so you need a car for $35,000, and it's a car you're going to be using one way or the other, right? So if the employee, the W-2 earner, goes out and buys that car, they're going to have to earn $50,000,
Yeah.
pay the taxes, and then net the $35,000. But if you have a business, and let's say you're writing off 50% of it, now the government is helping you take that amount and is giving you an incentive to invest in the business. So therefore, you're paying a lot less. Same $35,000 is costing you 50, and it's costing them a lot less than $35,000.
Yeah. No, you bring great points. Listen, Miguel, this has been another powerful and perspective shifting conversation. Again, thank you for sharing your insight and your experience. And for everyone listening, Make Life Less Taxing isn't about money. It's about freedom, it's about clarity, and it's about purpose. Keep building wealth, keep protecting your legacy, and keep learning how to live the untaxable life. We'll see you next time on the Make Life Less Taxing podcast. Thank you again, Miguel.
Absolutely. And if you want to come out here and meet with us, you can book an appointment to get some tax clarity. Go ahead and book it there, and you'll walk away knowing whether you're overpaying and how much you're going to be overpaying this year. And no sales pitch, just the facts. And we'll look at your taxes and give you an idea as to where you are. See you next time.
Yeah.
You got this.
Perfect. We're going to have the links and everything in the show notes. So again, thank you, and we'll see you next time.
Bye-bye now. Thank you.
Thanks for joining us on this episode of Make Life Less Taxing podcast. Be sure to check out our other top advisor interviews at makelifilesstaxingpodcast.com.